Welcome back to the deep dive. So if you've been following our discussions on trading, we spent a lot of time dissecting the really complex stuff.
The market mechanics, the tech platform.
All the different strategies. And it's just so incredibly tempting to believe that success is all about finding, that one perfect algorithm.
Yeah, magic bullet.
Exactly. Or mastering some super obscure chart pattern that nobody else has figured out.
But we've seen it time and time again. Brilliant minds, the fastest computers, really sophisticated strategies, and they just fail spectacularly.
Right.
I mean, if trading were just a technical game, every single quant, every experienced programmer, they'd all be printing money consistently.
But they don't. And today we're going to get into why they often don't.
We're confronting that uncomfortable, non-technical truth. The most sophisticated strategy in the world is, well, it's utterly worthless if the operator, that's you, the trader, is fundamentally undisciplined or exhausted or emotionally compromised.
Exactly. Our whole mission today is to dive deep into that final crucial piece of the trading puzzle.
Yeah.
The psychological pillar.
Yeah.
We're pulling out actionable, prescriptive habits directly from the source material. We're talking about structured goal setting from Chapter 7.
Right.
And establishing a high-performance, disciplined lifestyle, which is Chapter 8. That gets into diet and sleep. And then we're going to pull it all together in the conclusion from Chapter 9.
And we like to frame this whole discussion around what we call the trilogy of success.
Okay.
It's pretty simple: technology, strategy, and psychology. And we stress this because that psychological pillar, statistically, it's the one that's most likely to collapse under pressure.
And when it goes.
When panic or greed hits, it takes your flawless execution and your high-speed setup right down with it. So today we're going away from these abstract ideas like, just be patient.
Right, which is useless advice on its own.
Totally useless. We're shifting toward concrete, tangible changes you can implement, like right now, to make that pillar stable.
Okay, let's unpack this, starting with Chapter 7, Goals and Expectations. When most people first look at a trading screen, their goal is purely monetary.
Yeah, absolutely. I want to make X amount of dollars, and I want to make it as fast as possible.
But the research that's highlighted in the source material, it points to something much deeper about what goals are really for.
And what's fascinating here is that goals aren't just signposts to get you somewhere. They're actually described as one of the little ingredients that bring happiness.
We're talking about emotional well-being here, not just a bank account.
Exactly. The sources even reference research from the Journal of Personality and Social Psychology, and it shows that goals that are congruent with our deeper personal interests and values, they actually increase emotional well-being in a big way.
So it's not just about the outcome.
Not at all. It's not about the money. It's about aligning this really difficult daily process of trading with the person you genuinely want to become.
That makes so much sense because the goal itself changes as a trader matures. At first, the main emotional goal might just be survival.
Break even. Don't blow up the account in the first month.
Right. Then maybe it moves to something more meaningful and external, like I want to support my loved ones or achieve financial freedom.
But the material really emphasizes that at the end of the day, the most robust, the most lasting satisfaction, it doesn't come from the balance sheet.
It comes from the journey itself.
And the verifiable mastery of your own self-discipline.
Okay, so that's why the source material pushes us so hard to define goals way beyond just monetary targets.
Absolutely. Because if your main goal for the day is just, say, make $800, you create this immense psychological pressure.
And what happens if you're down early?
If you're down $700 in the first hour, you've just opened the door to all kinds of irrational, desperate decisions to try and claw back to that target.
So instead, your primary goal, your daily goal, should be more psychological.
Yeah.
Or emotional.
Yes, focusing on what you are actually working on today.
Okay, so give me an example. Instead of make $800...
Your goal is, today, I will correct my chronic tendency to average down on a losing position. Or,
I will focus explicitly on building on my strength in trading, say, 1-minute opening range breakouts.
Precisely. You shift your focus completely away from the volatile P&L screen to your own stable, measurable behavior.
You're controlling the inputs, not trying to predict the outcome.
Exactly. And the classic illustration of this is the case study of Matt G.
The weightlifter.
The weightlifter. A trader who applied 20 years of weightlifting discipline to his trading.
So he wasn't just, randomly chasing daily profits.
Not at all. He approached trading exactly like he would train for a competitive meet, with meticulous routine, constant measurement, and persistence.
He treated it like a high-performance sport, where all the little incremental gains matter more than any single day's final score.
He set daily goals, he kept these comprehensive notes on his setup execution, and he adjusted his strategy based on performance metrics, not on what the market was screaming at him.
His focus was just on tracking his own effort and sticking to his plan.
And the results? They weren't incremental, they were transformative.
What were they?
Matt G recorded a 72% winner rate for the month.
Right.
And paired it with a massive 4.2 to 1 profit-to-loss ratio.
That's not a secret indicator. That's not some magic formula.
No. That consistency, that edge, it came from applying daily focus and weekly tracking, just like following a progressive overload program in the gym.
And his psychological reps, what were they?
Things like waiting 5 minutes before putting on a trade, never ever averaging down a loser, calling out the confirmed pattern aloud before he even clicked the mouse.
These small acts of forced discipline.
Those were his reps.
This really brings up the essential question then. How does a person actually structure this kind of long-term psychological development, especially with the emotional roller coaster of early trading?
Well, the source material gives us a very structured milestone plan. It's like the scaffolding for this whole self-development journey.
It sounds like a way to manage expectations.
It is. It's a really good granular approach. It guides a trader's development across these multi-month segments. So month 1 is all about simulation, paper trading.
Okay.
Month 2, you go live, but with very small sizing. Month 3, you increase the size, but under super tight control. Then you have months 4 through 6, and finally months 7 through 12, where ideally that consistency starts to really solidify.
And here's where the rubber meets the road, right? For each of those segments, you have to answer the same set of 10 crucial questions.
And this isn't some soft-focused self-help. This is about defining the boundaries of success and failure with, like, mathematical clarity before you ever hit the buy or sell button.
So if you can't answer these 10 questions for your current phase,
you are operating without a map. You're just gambling.
Let's get into those questions because they really do seem like the foundation of a serious trading plan.
They are. They force you to define your risk structure. So number 1, what is your overall goal for this segment? And crucially, this should focus on a specific psychological weakness or mastering a single strategy.
Not just make money.
Never just make money. 2, will this be live capital in the simulator or a combination? You have to define the environment.
Okay, that makes sense.
3, what's the starting capital? Simple enough. 4, what is the daily profit target? But just as important.
Is number 5. What will you do if you hit your daily profit target?
Yes. This is so crucial. Do you stop trading? Do you move to a lower time frame? This is what prevents overconfidence and stupid risk-taking.
A classic winner's tilt.
Exactly. Then 6, the flip side. What is the daily maximum loss? That's your hard line in the sand.
And 7, what will you do if you hit it?
This is the circuit breaker for revenge trading. Are you going to shut the platform down, walk away, and journal your mistake? You have to decide that beforehand.
It's all about pre-commitment.
It is. Number 8, what is the acceptable risk per trade? In dollars or a percentage? This defines your position sizing. 9, what's the milestone goal at the end that will signal you to move on? And this has to be a measurable metric, like a 60% win rate or a consistent 2 to 1 PL, not just a profit amount.
And finally, number 10.
What will you do if you don't reach that milestone? Do you go back to the simulator? Do you extend the current segment for another month? This forces accountability.
You know, questions 5, 7, and 10 are incredibly powerful to me. They force you to pre-program your behavior for both success and failure.
It's an explicit attempt to neutralize the emotional brain in the heat of the moment.
But how does a trader, in that moment of a huge win or a crushing loss, actually remember that pre-programmed rule? What stops them from just ignoring it?
That's where the other tools for self-reflection come in. They're designed specifically to inject some gravity and structure into that commitment. It starts with what they call the future use statements.
This is where we get that fun high-stakes analogy about Biff and the Sports Almanac from Back to the Future.
Exactly. The idea is you write a pre-journey statement, but in the future tense. So, say 12 or 24 months from now, you're looking back at your present self.
You're writing from the perspective of success.
Right. It's designed to create this psychological gravity for your commitment today. By positioning yourself in that successful future, you impress upon your present self how important it is to stick to the plan now,
So you're looking back and giving advice to your past self.
And warning them about specific temptations, those moments of weakness that you know will threaten your ultimate success.
So letting Biff get the sports almanac is basically letting your undisciplined, impulsive self get a hold of future knowledge.
Which leads to reckless, stupid decisions today. If you're convinced you're going to be rich in 2 years, why would you stick to a 1% risk rule right now?
The statement is like a warning against your own self-sabotage.
Precisely. You are trying to prevent the Biff in your mind, the greedy, lazy, rule-breaking impulse, from totally wrecking the timeline.
What are some of the other tools?
The sources also suggest using time statements. These are quick, focused journaling exercises you do at set intervals, month 2, month 4, month 6, and so on.
Like a check-in.
Exactly. To assess your progress, detail what's working, and figure out how you're going to correct any missteps. It ensures you're constantly recalibrating.
And then there are the after-completion statements.
Right. Those are for when a whole phase is over. It lets you reflect on the entire segment's plan, the losses, the wins, the emotional state, and then methodically lay out the foundation for the next stage.
You know, for some people, that internal commitment isn't enough. They need external accountability.
That's so true. And we see the example of Bogono, a trader who took that idea to the next level.
What did he do?
He decided to journal every single trade and stream on Twitch.
He broadcast his trading.
Yep, even in French. And he said it explicitly. The public visibility would force him to follow his rules.
That's genius. It weaponizes your own pride.
It does. Knowing that other people are watching or that you have to report back on the process, not just the P&L, it prevents those isolated, weak moments that lead to those impulsive, screw it, let's go decisions.
So if we tie this all together, goal setting in trading is really about designing a resilient feedback loop.
Yes, one that prioritizes disciplined behavior and self-analysis over the immediate, fleeting emotional hit you get from monetary swings.
It makes your daily routine about behavioral compliance, not about trying to predict the market.
You got it.
Okay, shifting gears now to Chapter 8. This is where we broaden the focus dramatically. We're moving beyond the monitor and looking at the trader's entire life.
Right. The source material really emphasizes that trading is a high-performance, high-stakes activity. It's much more like being a professional athlete than an office worker.
And this is probably the most overlooked area in all of trading education, isn't it? It's often just dismissed as generic health advice.
Oh, completely. But we're talking about preventive maintenance. I mean, think about it. You're making split-second decisions in front of these fast-moving charts while you're also managing extreme internal emotions, fear, greed, ego.
That requires a healthy, fully focused, and chemically balanced mind.
Absolutely. If you are physically exhausted or nutritionally impaired, or you're relying on chemical crutches to get through the day, your cognitive decision-making is severely compromised, period.
And we have real-world stories that show this. The discipline for trading spills over into life discipline.
For sure. We hear about Federico, who was motivated to fix his diet strictly for trading success, and he ended up losing 35 pounds.
Just because he realized the discipline he needed for risk management was the same discipline he needed for managing his plate.
Exactly. And another story, a 52-year-old trader who it can be a powerful one. As one trader put it, trading gave him the reason he needed to finally remove that mental barrier to losing weight and getting healthy. It wasn't about vanity anymore.
It was about competitive necessity, peak performance.
You need every edge you can get.
Let's do a deep dive on the specific research here, starting with sleep and cognitive function. This draws heavily from Dr. Matthew Walker's work, and the implications for trading are just huge.
They are. Dr. Walker, who's a leading neuroscientist, he points out that if an athlete sleeps only 5 to 6 hours a night, their time to physical exhaustion decreases by about 10% to 30%.
Okay, so how do you translate that to trading?
Well, think of that as mental fatigue. If you are consistently starting the New York Open with a 30% reduction in your cognitive stamina, you are so much more likely to exhibit confirmation bias.
Or ignore key setups.
Or hit your maximum daily loss early just because of impaired, sluggish decision-making. Your brain literally doesn't have the endurance to manage the volatility.
So this isn't just about feeling a little groggy. This is about a measurable hit to your executive function.
Absolutely. And the source material gets very specific about 2 common chemical pitfalls that sabotage sleep: alcohol and caffeine.
Let's start with alcohol. Dr. Walker's point is that it's a sedative, not a sleep aid.
That is such a critical distinction. Alcohol does not help you get natural restorative sleep. It basically just knocks out your prefrontal cortex.
And crucially,
It suppresses non-REM deep sleep. And that type of sleep is essential for consolidating motor skills and memory.
so traders who have a glass of wine or a nightcap to relax after a tough day.
They are actively impairing their brain's ability to learn and consolidate the lessons from those very trades. You're just setting yourself up to repeat the same failures tomorrow because the neural pathways haven't been properly cemented.
And then there's caffeine, the morning fuel for pretty much every active trader. What's fascinating here is the discussion of its long half-life and quarter life. Most people think the coffee they drink in the morning is long gone by evening.
And that assumption is just deadly to performance. Caffeine's half-life is about 6 hours. That means half the dose is still in your system after that time.
And its quarter life.
It's 12 hours.
Yeah.
So let's make that concrete. If you have a big 200 milligram cup of coffee at midday,
Right.
50 milligrams of that caffeine is still in your system, actively blocking the chemical adenosine, that's the brain's natural sleepiness chemical, at midnight.
So it's preventing the natural buildup of sleep pressure.
Exactly. So even if you feel tired enough to go to bed because you've had a long day, the caffeine is still chemically muting your brain's sleep signal.
So you'll get that deep, quality, restorative sleep.
You can't. Your brain is still chemically wired. And if you're trading high volatility markets like the New York Open and you're relying on big doses of caffeine to stay alert, you could be compromising your mental edge for the entire week because your sleep quality is just consistently poor.
It becomes a self-defeating cycle.
It does. It leads to chronic attention deficit trait symptoms like distractibility, which is just toxic in an environment that requires focused patience.
Okay, moving on to food and nutrition. Another area where performance can just tank if we ignore it.
And Dr. Joel Kahn, the preventative cardiologist, he offers some pretty alarming data here.
What does he say?
He describes the almost immediate terrible impact that processed food can have on your circulatory system. He says that within 45 to 60 minutes of eating a high-fat, high-processed breakfast, like a big sausage muffin or a sugary pastry,
Yeah.
your heart arteries can temporarily malfunction for the next 6 to 7 hours.
Wait, hold on. Arterial malfunction. How does that specifically impact a trading decision?
Well, if your arteries are malfunctioning, that means you have reduced elasticity, reduced blood flow, and suboptimal oxygen delivery to your brain.
And trading requires intense clarity.
Especially scalping or day trading. It requires lightning-fast pattern recognition, the ability to make quick decisions without hesitation. If your brain is being starved of optimal oxygen and glucose right when the market volatility is hitting,
You're operating at a deficit from the start.
a fundamental deficit. It's not just feeling sluggish, it's a measurable reduction in your mental clarity.
So to counter that, Dr. Kahn promotes this easy-to-remember tool, GBOMBS.
Right, GPOMBS. It's a simple, actionable way to move toward high-performance nutrition without needing a PhD in dietetics.
So what does it stand for?
It's focused on plant-based powerhouses. So G is for greens, especially cruciferous vegetables like kale and broccoli.
The foundation.
Absolutely. B is for beans, which includes lentils, peas, soy. They're high in fiber, they stabilize your blood sugar, and give you that sustained energy to avoid the mid-morning crash.
Okay.
O is for onions and garlic, sulfur-rich, packed with antioxidants. M is for mushrooms, which have beta-glucans to help lower cholesterol. B is for berries, which are low glycemic powerhouses for brain health.
In S?
S is for seeds, like ground flaxseed, chia, hemp. They're rich in omega-3s, which are vital for brain structure and cognitive speed. But the caveat here is that they're very calorie-dense, so you need restraint.
Speaking of things that require restraint, the source gives a really stark warning about processed meats.
It does, and this is a moment that often passes too quickly, but the severity of the finding is it's significant.
What was it?
In 2015, the World Health Organization, the WHO, classified processed meats as a Group 1 carcinogenic.
And the language they used was really specific.
Very specific. They stated that processed meats cause colorectal cancer, not that they're associated with it, cause.
Which puts things like bacon, sausages, deli meat.
In the same risk classification group as smoking and asbestos, things that are scientifically proven to cause cancer.
That is a sobering thought.
It is. We're talking about something people just casually eat every single morning, and it's in the highest risk category from the Global Health Authority.
So given how tied to habit poor diet is, how does a trader actually make these changes? Going cold turkey usually just fails.
It does, which is why the source walks through Prochaska and De Clemente's 5 stages of change. It makes it all seem much more manageable.
Okay, what are the stages?
So stage 1 is pre-contemplation. That's denial. You're unaware or unwilling to change. You hear the stuff and think, that's not for me.
Stage 2.
Contemplation. You're getting ready. You're thinking about changing in the next 6 months. Maybe a health scare or chronic fatigue has you thinking.
Then you move to preparation.
Right, you're ready to act within 30 days. And the advice here is to start small. Just fix breakfast. Stop buying the processed meat. Switch to a smoothie or oatmeal. That small win builds momentum.
And after that is action.
You've modified your behavior for at least 6 months. Once breakfast is a habit, you focus on lunch. Aim for a gigantic, colorful salad every day. Prepare your own healthy lunch.
And the final stage is maintenance.
Sustained change. And this requires a support system. Just like you need a trading community, you need partners or friends who support the change and help you avoid relapse, which is common in high-stress jobs.
So the key psychological hack is to just start with breakfast.
Start small. Don't try to overhaul everything at once because you're just guaranteeing failure.
And this leads to Dr. John Berardi's advice on mindful eating. It's not just what you eat, but how.
He advises slowing down and using an eating journal to track if you're tuned in or tuned out.
Tuned in, being mindful of the food, the taste, how your body feels.
Right, recognizing those early satisfaction cues.
And tuned out is eating while watching the market, checking news feeds, surfing the web.
Exactly. You failed to recognize the satisfaction cues, and you just keep eating until you're stuffed and sluggish, not satisfied.
And that skill is, it's transferable, isn't it?
It's essential. Mindful eating helps you recognize when you're full. It's a skill a trader needs to recognize subtle market cues, too. If you can't recognize the subtle signal that your body is satisfied, how can you possibly expect to recognize the subtle signal that a pattern is failing or an opportunity is peaking?
It's the same kind of attention deficit. All right, so now we get to the final conclusions in Chapter 9, pulling everything together. Self-mastery, goals, peak performance. And we have to start this final section with the fundamental, harsh reality of the trading business itself.
We do. We have to reiterate the basic nature of this business. Trading is high risk, high stakes, and, crucially, it is a minus-sum game.
A lot of people mistakenly think it's a zero-sum game, right? For every winner, there's an equal loser.
That's the common misconception.
But if it's a minus-sum game, what does that mean in practice for you, the individual trader? And why does it demand such extreme discipline?
It means the entire industry ecosystem, the brokers, the exchanges, the market makers, data providers, regulators, they are constantly draining money from the system.
Through commissions, fees, spreads, taxes, slippage.
All of it. So the total pot of money available to traders is always shrinking. For the market to function, the winners actually have to receive less than what the losers collectively lose. That gap is the industry's profit.
That is such a powerful point. If the market is literally structured to perpetually drain capital from traders, then the need for an extreme psychological and technical edge, it's not even negotiable.
You can't afford to be sloppy. The deck is already stacked against you by default.
And this business model creates a very specific psychological burden, doesn't it?
Yeah.
Especially for people who thrive on control and perfection.
Oh, absolutely. It's highlighted by the story of the veteran air traffic controller, Armin.
Right. Armin is the perfect example of how trading is a nightmare for perfectionists. He spent 23 years being trained to never make a mistake.
Because a mistake in his old job could cost lives and trigger an immediate investigation. He internalized this mandate for 100% success.
And when he came to trading,
that deep programming meant he literally could not pull the trigger on a trade, even when the setup was technically perfect.
Because his brain equated any loss, even a small planned stop out, with what? Moral failure, catastrophe.
Exactly. He had immense difficulty accepting that a probabilistic system must have losses to prove its edge over time.
But the truth, for consistently successful traders, is the complete opposite.
They have to accept losses as just a normal, necessary cost of doing business.
Trader H posted the insight that consistent winners take losing trades all of the time.
Right. Their drawdowns are just a reflection of the normal statistical losses that a profitable method has to incur. Taking a small planned loss is actually a confirmation that you're a good, consistent trader.
Because you're sticking to your probabilistic edge, it's not a sign of failure.
It's just data, nothing more.
So this acceptance of a probabilistic reality, where does it lead?
It leads to resilience and learning. The source material emphasizes that effective traders are inventive. They practice what they call improvisation or bricolage.
What does that mean in a trading context?
It means being mentally ready for the unexpected, which is guaranteed in the markets. It means thinking ahead, having a plan B if your power goes out, knowing what to do if your platform freezes.
Or anticipating how a market might react to a known event.
Right. The sources compare this to the resilient mindset of concentration camp inmates who would pocket pieces of string or wire, seemingly useless objects, because they might become useful later in an improvised way.
So in trading, this means embracing your early losses as tuition fees.
Exactly. Tuition for learning how to survive in a hostile environment.
Speaking of things that cause immediate failure, one of the deadliest psychological sins highlighted is the fear of missing out. FOMO.
It's fundamentally wishful thinking masquerading as a trade idea.
And it leads to taking trades before a pattern is even confirmed.
Or trades taken without a solid risk-to-reward ratio defined beforehand. We see that painful story of the trader MD who put $55,000 into a volatile Bitcoin investment trust during the 2017 crypto mania.
Simply because everyone else was making money.
That decision was driven entirely by social proof and emotion, not by any kind of analysis or risk management.
So the lesson is simple, but hard.
It is. If you cannot identify a clear, defined entry point, a defensible stop loss, and an attractive risk-to-reward ratio, say 2-to-1 or better, then that trade is probably based on FOMO, and you just should not take it.
You have to trust your discipline over the urge to participate.
Always.
This all circles back to the final paramount distinction, the importance of focusing on your process over your P&L.
That is the ultimate differentiator. It defines the professional. Amateurs focus on the P&L, winners focus on the rationale for their actions.
They're constantly asking themselves, especially after a trade, what was the main reason behind my decision?
And that internal question helps you differentiate between acting out of raw greed or panic versus capitalizing on a genuine, verified opportunity that actually fits your plan.
And some traders take extreme measures to enforce that detachment. We learned about the junior prop trader, Panagiotis, who advised focusing on cents gained or big blinds instead of dollars.
That is a brilliant technique. It removes the emotional attachment to the monetary value. When you start thinking of your risk in terms of cents or pips instead of hundreds of dollars,
the emotional weight is just gone.
It's immediately lessened. And it allows for clearer, more objective execution of your strategy. You're dehumanizing the input to preserve the human element of your decision-making.
So if we look at the final key takeaway for self-development, it's really about making these critical behaviors habitual.
Turning them from conscious, difficult effort into automatic reflexes.
And Dr. Brett Steenbarger is quoted saying, "The great individual is simply one who has made a habit of self-development."
And that self-reflection, which has to be done daily through journaling and weekly through review, that's the mechanism that turns behavior patterns into habits.
And critically, that reflection needs to focus just as much on your strengths and successes, not just your weaknesses.
Yes, because that's what genuinely builds robust internal confidence.
And that completely reframes what self-confidence even means in this business. It's not just positive thinking.
No, not at all, Steenbarger clarifies. Self-confidence is not expecting the best. It's knowing deep inside that you can handle the worst.
A confident trader can look at a hard stop loss they set and know they'll be okay if it gets hit.
Their confidence comes from their disciplined adherence to the process, not from their belief in the outcome of the next trade. And that's a profound shift in mindset that takes the pressure off winning and puts it squarely on surviving.
So what does this entire comprehensive deep dive into goals, psychology, and lifestyle ultimately mean for you, the person listening to this?
It means that the self-discipline and the lifestyle changes that are required for survival in the minus-sum game of trading, the better sleep, the cleaner diet, the structured goals, the continuous self-reflection, all of it will inevitably improve all aspects of your life.
Trading is like a laboratory for human discipline.
It is. It demands excellence in areas that most other professions let you ignore, whether that's your health, your financial planning, or your emotional control.
And that brings us to the final piece of wisdom from the source material. A reminder that the work is never really done.
To improve is to change. To perfect is to change often.
That is a powerful way to synthesize all of this. We've seen today that trading success really isn't about finding a magic strategy or buying the fastest computer.
Oh.
It's about rigorously optimizing the human operator through disciplines like your goals, your sleep, your diet, and your self-reflection.
Absolutely. Reviewing this final crucial pillar makes it so clear that The market is always going to be there, but your mental edge is perishable. Your ability to execute flawlessly today is directly tied to how you treated your body and your mind yesterday.
So we want to leave you with a direct challenge building on everything we've discussed.
Okay.
Go back to those 10 questions for setting a structured milestone plan. Specifically, the questions about your capital, your acceptable risk per trade, your daily maximum loss, and the action you take when that loss is hit.
And ask yourself honestly, which of those 10 questions are you currently struggling with the most? Which predefined boundary or rule is your collapsing pillar right now?
And the provocative thought is this. What single, practical, non-monetary action will you take today, not tomorrow, today, to make sure that component of your plan is protected?
Recognizing that the motivation to move away from pain is always stronger than the motivation toward pleasure.
So will you write down that hard stop-loss rule and literally tape it to your monitor? Will you delete the coffee maker schedule from your phone?
Will you set a mandatory alarm on your phone for 1:00 p.m. to remind you to stop trading after 4 hours, no matter what your P&L is?
Whatever it is, take that small, process-focused action right now.
Thank you for joining us on this deep dive into the final pillars of trading mastery.
Until next time, stay disciplined, stay resilient, and trade well. Today we are confronting what is, I think, the ultimate challenge in high-performance trading.
And it's not the charts?
No, it's not the complex math, it's not the chart patterns, not even the speed of your internet connection. It's the 3 inches between your ears. We are plunging headfirst into the one area of trading that all the technology and all the strategy in the world just cannot fix. And that's the human mind.
That is absolutely right. I mean, for anyone listening who's ever tried to master the markets, you know this reality. It's so frustrating.
It is.
And the sources we've pulled together for this, I mean, it's a really robust collection of firsthand reports, frameworks from real retail traders, real mentors. They all confirm this one disturbing truth.
This is what?
That highly intelligent, highly motivated people with solid strategies, with access to amazing technology, still just spiral out of control the second the pressure hits.
But it really makes you wonder then, if the technical knowledge is out there, why is the success rate so low? So our mission today is to unpack what our sources call the mental trilogy of success in this field.
Right. You've got technology, strategy,
And the big one, psychology.
The big one, the one that trips everyone up. We have to understand why psychology isn't just, a part of the game.
It is the game.
It is the defining factor, the single thing that separates consistent long-term success from just catastrophic failure.
And we're not talking about abstract ideas here, are we? We've got some pretty compelling anecdotes.
Oh, yeah. Immediate, shocking stories that show just how fragile the trading mindset is. Take the trader we'll call Robert.
There you go.
He was deep in a losing streak, but instead of stopping, he entered what he later called a filge one.
A filge one.
Yeah, which in his, let's say, raw honesty stood for F it, let's go.
Wow. That phrase just perfectly captures it, doesn't it? The complete emotional abandonment of discipline.
It's not even a thought, it's a surrender. A total surrender to impulse.
So what happened?
Well, he is extremely self-aware about it afterward. He called his meticulously built rules, his checklists, he called them delicate paper walls.
Delicate paper walls.
Yeah. That just came tumbling down under pressure. The money he lost was almost secondary to the psychological failure. He felt ashamed. He even joked about needing to visit a monastery to cleanse myself of all these trading sins.
So he saw it as a moral collapse, not just a bad trade.
A psychological collapse, absolutely. And it's not just beginners who do this. Look at Trader Siri.
Right, the senior engineer from Silicon Valley.
The definition of technical aptitude. Smart guy, completed his training, had the tech, had the plan, and within weeks of going live,
wiped out his account.
Wiped it out. Sure. And Siri is the perfect illustration of this huge gap we're talking about. The sources are clear on this. Today, those first 2 pillars, technology and strategy, they're basically democratized.
They're available to everyone.
Right. Advanced platforms, market access, all this education, it's widely available, a lot of it for free. You can buy the best software, read the best books, but that just gets you to the starting line.
Because that third pillar, psychology.
Yeah.
That's the real differentiator. How do you download discipline? How do you install patience?
You can't. And the standard advice to be in the zone or stick to your plan, I mean, that is utterly meaningless when panic is setting in.
So this deep dive is about grounding these ideas, taking these abstract concepts, and seeing how they play out in the shared struggles of real traders.
Exactly. We're looking for the psychological safeguards that turn those fragile paper walls into concrete, durable frameworks that, actually let you function when you're under extreme market stress.
Okay, so let's unpack this environment then. Why is trading so fundamentally different from, say, a successful corporate career, even a really high-paying one?
The key distinction, and it's a huge one, is that trading is a high-performance activity. It's more like being a professional athlete or a competitive chess player.
Not a 9-to-5 job.
Not at all. It demands that you are in a peak emotional and psychological state, operating completely free of your own biases or prejudgments. And you have to sustain that hour after hour.
And there's no buffer. The moment you sit at that desk, you are a singular, independent decision maker.
Making snap, high-stakes decisions with immediate accountability.
This is where that first crucial self-assessment comes in.
Right.
The question you have to ask yourself.
Yes. Do you perform best as a decision maker or as an advisor? The sources show that so many brilliant professionals fail at trading because they're used to being excellent advisors, but they're not used to being the one who makes the final binding decision.
The General George Patton analogy here is fascinating. It really drives the point home.
It's perfect. General George Marshall respected Patton immensely. He said he was the best subordinate the American Army had ever produced.
The best subordinate.
But Marshall also believed Patton would have been the worst independent commander.
Why is that?
Because Patton's genius worked best inside an established command structure where the ultimate weight of the final call, the fallout from a mistake, rested somewhere else.
And that applies directly to traders.
Directly. You can know the right answer, but if you can't execute it under pressure and bear the full burden of being wrong, you'll fail. Because in trading, you are always in the top spot. You're always the commander.
So if you are the sole commander, how on earth do you manage the chaos, the sheer velocity of the markets?
This is where the sources direct us to a critical framework. It was actually developed for chaotic military engagements. It's called the ODA loop.
The ODA loop. Okay, break that down for us.
So it's OODA. Observe, orient, decide, and act. It was developed by a U.S. Air Force Colonel John Boyd for fighter pilots.
Fighter pilots?
And it's perfect for trading because it's all about rapid cycle time in a highly competitive, really uncertain environment.
Okay, so the process starts with observe.
Observe is about building a comprehensive, accurate picture of what's happening right now. For a pilot, that's the enemy, the environment, their own plane. For a trader, it's the real-time chart data, the volume profile, the level 2 order flow, breaking news.
So just gathering all the raw data.
Right, making sure your input is current and robust. But then comes the most critical step, and the one most people overlook. Orient.
Orient. The sources say this is where a trader's edge really comes from.
Orientation is the filtering stage. This is where you connect those raw observations with reality, interpreting them through your mental model. But crucially, you have to filter out your own cognitive biases.
So, for example,
you might observe high volume, that's the raw data, but if your orientation is clouded by confirmation bias, you want the stock to go up because you already bought it, you will completely misinterpret that signal.
So your want gets in the way of what's actually happening.
Precisely. Boyd argued that a superior orientation lets a pilot outsmart an enemy, even if the enemy has a faster jet.
Which means a trader with fewer monitors, maybe even a slower news feed, can still outperform someone with better tech.
If they have a clearer mental filter, absolutely. Orientation is about self-awareness. It's about fighting that anchoring bias, clinging to an old price target. It's about recognizing when reality on the screen conflicts with your prediction and then adjusting your model instantly.
Right. So once you're oriented, you decide.
And this is where you choose the most relevant option based on that updated reality. It requires flexibility. The sources warn against first conclusion bias.
Meaning you stick with your first plan no matter what.
Yeah, sticking with your initial trade idea even when new data completely invalidates it. A good decision in the ODA loop means you're constantly updating your hypothesis with new information, not stubbornly clinging to a trade that's no longer working.
And then finally, act.
Execute, swiftly and precisely. The whole point of the ODA loop is that the winner in these chaotic situations is the one who can cycle through ODA faster and more accurately than their competition.
And all this speed is necessary because you're fighting against the very nature of the market itself. We have to kill this idea of a zero-sum game.
We really do. This is a foundational realization for anyone getting into this. A zero-sum game means for every winner, there's an equal and opposite loser.
But trading isn't like that.
Not at all. It's a minus-sum game because there's friction. The entire industry ecosystem, the banks, brokers, exchanges, regulators, market makers, they are constantly draining capital from every single transaction.
Through fees, commissions, spreads.
Exactly. The bid-ask spread. So when $1 million changes hands, the winners actually get less than what the losers lost. The difference is that friction, that cut taken by the ecosystem.
So the playing field is actively slanted against you from the start.
Actively. Market makers make their living capturing that spread and exploiting slippage. If you're running a high-frequency strategy, you might be paying $5 in commissions round trip plus slippage on a tiny profit. Over 100 trades a day, that frictional cost is enormous.
So to win consistently, you don't just have to beat the other guy.
You have to beat the other guy and the house at the same time.
It's why the sources compare it to poker, but with higher stakes.
Right. Both offer tons of opportunities daily, which is a double-edged sword. It means flexible profit chances, but also massive exposure to overtrading. And in both, your big wins come from a very small percentage of your actions.
Professional poker players beat the house by exploiting weak players.
And traders have to use skill and psychological control to overcome that inherent market friction, which leads directly to the mental requirement of accepting loss.
If friction is constant and probability is in charge, then a loss isn't a mistake.
It's a business expense, a necessary business expense. Trader H said it perfectly. Consistent winners take losing trades all of the time.
Drawdowns aren't personal failures.
They're just a normal reflection of a strategy's built-in losses. You have to internalize them as tuition paid to the market. If you see a stop loss as a failure, you'll fight it, and you'll turn a small, acceptable expense into a catastrophic, career-ending loss.
Okay, so if loss is inevitable, if it's tuition, then the real question becomes how quickly you can recover from that loss. Which brings us to Section 2. The power of resilience.
Resilience is the core measure of mental toughness. It's that ability of the human psyche to rise from the ashes, like a phoenix, after a major setback.
Like losing a job, a death, a divorce, or in this case, a bad trade.
A bad trade, or a huge portfolio drawdown. And unlike in most careers where setbacks are, intermittent, traders face these psychological tests almost daily.
So that emotional recovery requires a kind of persistence that most people just don't use in their day-to-day lives.
To really illustrate this idea of resilience versus, the lack of it, the sources give us this brilliant contrast from music history.
Let's start with Dave Mustaine. He faced a huge rejection early on.
Monumental. Mustaine was famously fired from Metallica, one of the biggest bands in the world, right before they recorded their first career-defining album. Instead of collapsing, instead of becoming a victim, he channeled his anger and ambition into this explosive energy and immediately formed Megadeth.
Which became a legendary band in its own right.
A heavy metal legend. His professional rejection literally fueled a competitive fire that led to an equally massive success. That's resilience in action.
Now you compare that to Pete Best.
Pete Best, the drummer for the Beatles, kicked out right before Beatlemania exploded across the world.
Horrible timing.
He just didn't have that inner mechanism to bounce back. He didn't form a competing band. He didn't channel that energy into a new venture. He fell into a deep depression, alcoholism, and he even attempted suicide later on.
So the external event was similar, a massive career-altering rejection.
Yeah.
But the internal psychology was completely different.
And dictated completely different outcomes. It just underscores that success in these high-pressure fields isn't about being immune to rejection. It's about your system for processing and using that pain.
And this isn't just an individual trait. The sources show it can be learned and implemented systematically.
Yeah.
The examples from 9/11 are incredible.
Right. Take Morgan Stanley. They were in the South Tower of the World Trade Center, the largest tenant, but they suffered shockingly few losses.
Oh.
Organizational resilience. After the 1993 bombing, they implemented serious preparedness programs, evacuation drills, detailed plans.
So they had practiced for disaster.
They had. When the first plane hit the North Tower, their team leader immediately initiated the evacuation protocol. They got out of the South Tower within 1 minute of that first impact. They lost only 7 employees. It wasn't just luck. It was disciplined preparedness.
And then there's Lehman Brothers. Their headquarters were severely damaged.
And they recovered in less than 48 hours. They set up an impromptu trading floor in a New Jersey hotel.
Wow.
and immediately position themselves to benefit from the volatility when the markets reopened. That is bricolage, improvising solutions from what's available, and it's discipline. It shows resilience lets you not just survive a crisis, but potentially profit from it.
So these lessons translate directly to the 3 psychological pillars for building resilient traders. The first is accepting reality.
You have to abandon the get-rich-quick fantasy. You just have to. Resilient traders face that steep, painful learning curve with what the sources call staunchness.
Staunchness. I like that word.
If you believe success will come easy in 6 months, you're going to interpret the inevitable drawdowns as proof that you're a failure, which leads to panic. The reality is that consistent profitability takes time, and it takes hard losses.
Okay, the second pillar, learning from mistakes. This is about shifting your internal story when those losses happen.
This is so critical. Instead of asking, why me, which makes you a victim of the market, you have to ask, what happened? What was my rationale here? What data did I miss?
So you become a detective, not a victim.
Exactly. Successful traders build a meaningful construct around their suffering. They dissect failures objectively. They view the loss as data, not as destiny, and they use that data to build better skills. You embrace the failure because it gives you the map for how to improve.
And the third pillar is improvisation, or bricolage. This sounds like planning for the worst.
It's the ability to construct creative solutions from whatever is at hand. It's planning for your platform to break down, for your power to go out, for a catastrophic emotional trading day before it happens.
That Mike Tyson quote, right? Everyone has a plan until they get punched in the mouth.
That's it. Bricolage means you've already rehearsed plan B, plan C, plan D. A resilient trader has a backup computer ready. They have a written contingency plan for how they'll shut down their account if they break a major risk rule.
You pre-decide the actions for when chaos hits.
Which avoids improvised, panic decision-making, which is almost always irrational. And we can't forget the foundation for all of this mental toughness.
The physical foundation.
A healthy body, a clear mind. If trading really is a high-performance activity, then you need to be at peak physical and cognitive function.
You're sitting in front of fast-paced charts, making complex decisions, dealing with extreme emotional volatility.
All of which drains your mental energy like crazy. If you're neglecting sleep, diet, hydration, you're setting yourself up for impaired decision-making. The sources cite one 52-year-old trader who drastically improved his sleep and his drinking habits just to meet the cognitive demands of the trading day.
You can't sustain mental toughness on a diet of stress and no rest.
You just can't.
We've established how vital resilience is. Now let's get into the specific psychological hazards that are actively trying to undermine that resilience. We have to start with the big one, the deadly sin. Fear of missing out. FOMO.
FOMO is pure aggressive wishful thinking, and it is turbocharged by our digital environment today. It's when a trader sees a stock running and just jumps in, no confirmation, ignoring their predefined entry criteria.
They're just chasing it.
Chasing it because they believe everyone else is making money.
And the sources use the 2017 cryptomania as a perfect example of this.
A perfect laboratory for FOMO. Think of Trader MD. He watched the frenzy, and even though he didn't have a proper risk management plan, he threw $55,000 into a highly volatile Bitcoin investment trust. When the crash came, he lost $15,000, and his rational mind knew he was gambling. But that fear of missing out on the huge gains he saw everyone else reporting it was overwhelming. He admitted the failure was purely psychological. He ignored the fundamental rule of defining his entry, his exit, and his stop loss before he clicked the buy button.
This connects to a powerful tool the sources bring up, the boundary rule.
Yes, this is like a personal trainer explaining a diet. It is psychologically easier to hold true to a principle 100% of the time than 98% of the time.
The no cheat day rule.
Exactly. If you tell yourself, I won't eat junk food except on cheat day, the cheat day often spirals out of control. In trading, this means no cheat trades.
So, once you justify crossing that boundary just once, taking one speculative FOMO trade, you've put a psychological crack in the dam.
And it becomes infinitely easier to do it again the next time that impulse hits. The boundary works because it's absolute. You violate it, you've admitted a weakness, and you've eroded the foundation of your discipline. And that opens the door for the next hazard.
Overtrading, or as Robert called it,
crack addict trading syndrome.
Cats. His account of cats is just brutally honest, isn't it? That downward spiral of chasing money.
He described being up for the day, but being unable to walk away. Then he starts giving his winnings back. And the moment that money is gone, he feels this intense connection to the capital that used to be mine. And it generates this powerful urge to get it back.
Which leads to impulsive, irrational trades designed only to recoup losses.
Which guarantees a deeper hole. And this isn't just a failure of willpower. This is rooted in brain chemistry.
It's addiction.
It is. Trading provides intermittent reinforcement, and it stimulates the brain's pleasure center, the nucleus accumbens, with dopamine.
That dopamine hit reinforces the thrill of the win.
And that trains the brain to trade compulsively, just like a gambling addiction. The excitement of the action overrides the rational analysis of the risk.
There was a study of institutional prop traders mentioned in this context.
A fascinating study. It showed that successful, long-tenured institutional traders have elevated dopamine levels. They're natural high-risk takers, but they also have a greater expression of the genes that actively control risk-taking behavior.
So they have the gas, but they also have really good brakes.
That's a perfect way to put it. Longevity comes from taking a calculated, balanced level of risk, guided by discipline, not just impulse. The retail trader needs to build structural safeguards to replicate that internal balance.
And one behavior that just accelerates cats and destroys accounts is averaging down. The sources call this the beginner's ruin.
It is probably the single most common mistake that ends short trading careers. Now, scaling into a trade can be a powerful technique.
But only on winning positions.
Only when you're adding size as the market confirms your initial thesis. Averaging down on a losing position is irrational behavior driven by one psychological desire. The desire to be right.
You're just throwing good money after bad to lower your cost basis and avoid the pain of admitting you were wrong.
Exactly. And the sources give this catastrophic example from a mentor who nearly blew up his career on a biotech ETF, the Review. The stock plunged from $120 down towards $60.
And he kept buying.
He kept adding shares, trying to lower his average price. He ended up holding 800 shares at an average of $77.50. He was so fixated on avoiding the loss that he let the position just balloon out of control.
And the inevitable happened.
The price kept dropping to 58, triggering a margin call. The broker liquidated the entire position. He didn't just lose the capital, he lost the buying power he needed to get into new, good trades.
Averaging down guarantees your biggest loss will always be the result of stubbornness.
A stubborn desire to rescue a bad idea instead of just accepting the initial small stop loss.
The final psychological hazard here is the perfectionist's nightmare, where a successful past career actually becomes a huge liability.
The story of Armin, the air traffic controller, is just so poignant. For 23 years, his entire career was built on avoiding any mistake.
Because an error could cost lives.
And lead to rigorous investigation, maybe getting fired. His brain was hardwired for zero failure tolerance.
So when he became a trader, he couldn't pull the trigger. He couldn't accept loss as a necessary part of the process.
He would identify the perfect setup. The entry criteria were met, the volume was right, everything was perfect. But then he'd hesitate, double-checking, paralyzed by the fear of being wrong. He actually wrote that for him, failure is not an option.
But in trading, failure is an option. It's a statistical certainty.
You have to accept that your win rate, even if it's high, will never be 100%. The very conditioning that made him a stellar air traffic controller was actively preventing him from becoming a successful trader. He had to unlearn decades of conditioning.
So if the core problem is this deeply psychological, then the solution has to be structural. It has to be highly disciplined. Section 4 is all about building those practical safeguards to enforce logic over emotion. And it starts with establishing clear, unyielding rules.
A plan is just a nice document if you can't implement it at crunch time. The sources stress this over and over. The rules have to be strict. They're not suggestions. They have to be non-negotiable.
The veteran firefighter, Matt, gave this really powerful insight. He said that trading gave him more anxiety than walking into a burning building.
Just think about that comparison for a second. In a fire, the threat is external, it's visible, and you can manage it with established protocols. In trading, the threat is internal.
It's greed, it's panic, it's impulse.
And Matt realized that following simple black and white rules was the only way to suppress those internal emotions that fog your judgment. He had to treat his trading rules with the same life-or-death seriousness as his firefighting checklists.
He even posted simple phrases on his monitors as constant reminders, a very structural way to keep his logical brain in charge.
And his advice for novices was a simple structural safeguard. Strictly limit your share size. He said it prevents every beginner trader from blowing through their account.
Because if the position is small enough, The emotional pain of a loss is minimized.
Which allows you to focus on the process, not the money.
Let's talk about another critical safeguard: daily profit targets. Dr. J gave some deep psychological reasons why this is so important, even though statistically each trade is independent.
The issue is the human element, the human trader. While the market might be random, traders who keep trading after they've hit a financial goal often lose money. And it's due to two key psychological factors: subconscious overconfidence and decision fatigue.
That's a fascinating link. How does the stress of a trading day lead to decision fatigue?
High-stress decision-making rapidly depletes the brain's resources, especially in the prefrontal cortex, which is what governs your logic and your impulse control.
So your brain literally gets tired.
It gets tired. And as the day wears on, especially after a successful or a really high-stakes trade, that fatigue sets in. And this leads to lazier subconscious choices. You start ignoring confirmation signals, you relax your stop-loss criteria.
Or you just take trades based on a gut feeling instead of your process.
Exactly. So a profit target acts as an objective structural stop-loss for your entire mind.
That's a great way to put it.
Once you hit the target, your mission is complete. You walk away, you preserve your capital, and you avoid the exhaustion that guarantees you'll perform poorly later.
And it also defines that nebulous, always present desire for more.
That is the psychological genius of it. Unchecked, the desire for more just becomes greed and carelessness. It's a goal that can never be reached. A definite profit target provides a finite acceptable value for more.
So you get the positive reinforcement, but you minimize the risk.
You celebrate the win, and most importantly, you protect it.
This focus on defined process leads us right into Chapter 5, staying focused. The sources introduce this idea of attention deficit trait, or ADT.
And ADT is not clinical ADHD. It's a neurological phenomenon brought on by the demands of modern life. Constant information streams, multi-monitor overload, social media noise.
It leads to distractibility and an inner frenzy.
A state that is the complete opposite of the calm, clear focus you need for consistent trading.
So how does a trader fight ADT and maintain that winning mindset?
They have to shift their focus. They have to move away from the daily dollar value, which is what amateurs obsess over, and focus on the process and the rationale.
And the critical vehicle for maintaining this focus is the trade book.
The trade book. Mike Baer, the Marine Corps veteran, was a huge advocate for this. And it's not just a written strategy. It's a detailed manual. It outlines every single step of a specific strategy, from your morning routine to your post-market journaling. It's a blueprint for operating under pressure.
This is where we need to get specific for our listeners.
Yeah.
What exactly makes a trade book an indispensable safeguard?
It has to include 3 key sections: identification, entry-exit stop-loss details, and consideration. The trade book ensures that every decision you make in the heat of the moment has been pre-validated and planned for in a state of calm.
So give us an example. What would the specifics look like for, say, a 1-minute opening range breakout strategy, an ORB?
Okay, so the identification section for an ORB has to be rigorous. The stock selection criteria might say only low float stocks, less than 25 million shares, with heavy volume, more than 3 times the average, and gapped up more than 10% pre-market.
So if it only gaps up 9.5%, the trade book says no. The trade is forbidden.
Exactly. It removes the emotional decision. Then the entry-exit details have to specify exactly where to enter. For instance, breaking the first minute's high, only if volume exceeds the 5-minute average, and where to start, a hard stop at VWAP or the low of the first minute, whichever is tighter.
That is incredibly specific.
It has to be. And then the consideration section is where you build mastery. This is where you include a scale, say 1 to 10, for measuring the quality of your execution. And you write objective notes on how to improve, focusing on your adherence to the process, not the money. Was the setup textbook? Did I stick to the stop? That's the focus.
And the overwhelming consensus from profitable traders is that new traders have to focus on mastering just one strategy.
Sihanouk emphasized this. He said new traders should pick one simple, high-probability strategy, like an ORB or an ABCD pattern, that they easily understand and just look for it day in and day out until you feel like you can see it on a chart without even thinking about it.
The goal is just to tread water, to survive long enough to build that mastery.
Right. If you try to master 5 strategies at once, you guarantee distraction and psychological strain, which leads right back to that impulse trading and ADT.
Chapter 6 brings the focus entirely inward. You have to define your trader personality. If the strategy doesn't align with your core psychological makeup, your risk tolerance, you're just setting yourself up for an unnecessary internal fight.
This is so vital for building supreme confidence.
Yeah.
If you have a low-risk, detail-oriented personality and you force yourself to be a high-frequency scalper,
You're going to be a nervous wreck.
you'll be filled with panic and paralyzing hesitation. You have to choose a style scalping, swing trading, position trading that genuinely fits your tolerance for volatility and speed.
And the sources give some very explicit warnings here, specifically discouraging new traders from trying to trade low-float stocks.
For a novice, low-float penny stocks are extremely difficult to manage. The moves are highly volatile, they're hard to read, and they're often manipulated by larger players.
Hossein, who is otherwise successful, lost $3,000 on them.
Because he couldn't resist trading these low-float garbage penny stocks, as he called them. The risk management is so challenging, and the losses often wipe out months of small gains. It just makes the learning curve unnecessarily punitive for someone who is still psychologically fragile.
It's also critical to understand your own internal energy rhythms. Timing morning versus afternoon. It's not just about market volatility, is it? It's about your own cognitive performance.
Exactly. Morning trading is fast, it's furious, it's where the most volume and money are. It demands peak concentration and speed.
But Jason found consistent success exclusively in the afternoon.
He did. And Sky agreed, noting the afternoon is slower. It allows more time to think, to analyze steady trends, and to execute with less haste. A smart trader self-assesses. If you consistently trade poorly in the intense morning hours, shifting your focus to the slower afternoon is a brilliant psychological solution to your specific performance problem.
And once you find your niche, your time frame, your strategy, your size, the final advice on execution is crystal clear. Follow no one.
This is the only way to build that supreme, unshakable confidence. If you're just copying a moderator's P&L, you are doomed. Your size, your account risk management, your unique psychological limits are all different. You have to only trade setups that fit your personality.
The conviction has to be your own.
It has to be internalized. As one trader said, confidence in your setups makes it easy for me to trade them, to hold them for defined targets, and to not be shaken out quickly. If you're trading someone else's conviction, the first sign of trouble will cause you to panic and sell because the rationale wasn't truly yours.
So to develop this independent mastery, the most enduring safeguard is self-reflection. This is how you turn chaotic behavior into reliable, disciplined habits.
You have to schedule time for it. Daily and weekly self-mentorship. The sources highlight the research of Dr. James Pennebaker on expressive writing.
Which is writing about emotional upheavals for 15 to 20 minutes a day.
Right. And this simple act forces the brain to organize chaotic emotional thoughts into a structured narrative. When a trader writes about a blow-up trade, they shift the focus from the pain and anger, why did I do that, to objective analysis. What were the inputs? What rules did I break?
So it organizes the chaos.
And this process actually strengthens the immune system and improves overall mental health and clarity. It's an incredibly effective way to process trauma and learn from it.
But the journal can't just become a library of self-criticism. It has to be balanced.
Crucially, yes. Your self-reflection must focus on your strength and your successful executions just as much as on your mistakes. The goal is to build confidence, not self-loathing. And this leads us to Dr. Brett Steenbarger's powerful redefinition of confidence in the context of trading.
And what is that definition?
Self-confidence is not expecting the best outcome from a trade. It's knowing deep inside that you can handle the worst.
That's powerful.
The resilient, self-confident trader accepts that a stop loss will get hit. It's part of the game. But they know they will manage the resulting emotion and the capital withdrawal peacefully and be ready to execute the next trade with precision. That psychological hardwiring.
Yeah.
That is the true measure of mastery.
This entire deep dive has just confirmed it. The battle for consistent profitability is fought and won entirely within the mind. So let's summarize the core pillars of psychological defense we've explored today.
Okay, first, you have to accept the fundamental reality. Trading is a minus-sum game based on probability. Losses are necessary tuition. Your whole business model depends on treating drawdowns as inevitable friction that you just have to absorb and move past.
Second, build psychological resilience against those daily setbacks. This means abandoning the illusion of easy success. It means learning constructive meaning from every single mistake. And it means implementing those improvisation plans. The bricolage for when platform chaos or emotional meltdowns hit.
And third, you have to combat the deadly psychological hazards, FOMO in cats. You implement structural safeguards, like strict written rules posted right on your monitors, and you define daily profit targets to prevent decision fatigue and stop that endless pursuit of more that always leads to revenge trading.
And finally, sustain your focus and your discipline through process mastery. Build your individualized trade books, detailing every single step. Commit to mastering one simple setup that fits your personality until it becomes second nature, and stop following anyone else's conviction.
This self-development connects back to a much bigger picture, the self-mastery and the discipline required to succeed in trading. It inevitably spills over into all other aspects of your life.
We saw some compelling stories on that.
Federico losing 35 pounds, the 52-year-old improving his sleep and drinking habits. The rigorous focus on peak cognitive performance for trading became the catalyst for a total physical and mental transformation.
The market forces you to be your best self. Mahmoud, one of the traders, said trading is such a perfect reflection of myself. It demands that you address your weaknesses in your routine, your diet, your rest, because the market will immediately exploit any deficit you have.
So here is the final provocative thought for you to carry forward. If trading success requires peak performance, and the market is a perfect, unforgiving mirror of your mental and physical state, what change must you make right now in your daily life and your discipline around sleep, nutrition, or routine to achieve that necessary level of self-mastery at the trading desk?
The pursuit of a professional trading career is ultimately the pursuit of mastering yourself.